All right, welcome everybody to another edition of Think with a Drink. This is the weekly webinar series brought to you by the ARIES Foundation for Financial Education. And tonight we're doing, this is sort of like, Craig, it's become an annual thing for us at this point, right? We do sell in May and go away.
And we did this one last May?
We did, yeah, we've done it every May, basically. We talk about, what's going on and the adage and why sell in May prevails or is still kicking around and the story behind it. And, the reason for bringing it up this year is, not to continue to beat up with things, but the fact that for this particular year, for 2023, why sell in May not necessarily fit, actually, and might be a year to sort of toss that out the window, if you will. There's actually a term for that.
What? Set something aside, you mean?
No, throw something out the window.
Oh, okay.
It's called defenestrate.
Oh, okay.
If you look up defenestrate in the dictionary, it's to toss something out the window.
That's a $20 word.
There you go. Yeah. So it's just one of those weird things, you learn at some point and realize that they actually made a word up for. It reminds me of, you ever see the movie Broken Arrow?
Oh, yeah.
Right? It's the whole idea of, why do you even have a term for losing a nuclear weapon? That was sort of the adage there. That was like, why would you even have a term for this, right? That you could lose a nuclear weapon.
Yeah, and the hero of that movie is your favorite actor of all time, right?
Yes, yeah, Mr. Slater, absolutely. All right, so, as we have talked about, the Think with a Drink is brought to you by the ARIES Foundation for Financial Education. You can visit us on the web, ariesfoundation.org. My name is Tom Alessi. I am the president of the ARIES Foundation. I have been in financial services I'm in my 24th year, some way, somehow, when you slice that all out. I'm an investment advisor. That means that I act in a fiduciary capacity whenever giving guidance or advice to any of my clients. I want to bring my vice president in. Craig, if you can introduce yourself.
Sure. So I'm Craig Richardson, vice president of the ARIES Foundation. I've been in financial services a little over 19 years now, and I specialize in working with families and individuals to help them define their goals and have a better relationship with their money.
So if you ever have any questions for us, you can go to the website. Just know that we record these, we share them on the website, we share them on our YouTube channel. All we ever ask is, we're a nonprofit, we're doing this for educational purposes, that if you're going to share it, you share it in an educational manner. All right, we got through all of that, Greg. Now we come to the fun part of this evening. Okay. Yes, so the fun part of this evening, we call this Think with a Drink, because we feel that financial services, money matters, things of that nature tend to be a little intimidating, a little challenging, frankly, something that most people just want to put off into, the future time frame. I don't want to deal with it. Money's not my thing. We get that a lot, and, I don't want to have to deal with that. So we want to make it a little bit more engaging, a little bit more relaxing. And honestly, we can't think of a better way to do that than if we have something cold to sip on. And for tonight's enjoyment, we have Post Shift from Jack's Abbey. Now, see, the whole idea, Craig, is, right, so sell in May and go away has been around forever, but we're looking at maybe changing that or shifting our perspective for this year. So we're going to have Post Shift from our friends at Jack's Abbey. This is a Pilsner. So different from before, we had one of their Hell's lagers before, right? So Hell's is going to be a little bit more maltier than, say, the Pilsner. Pilsner will be a little bit lighter. This is certainly a crushable lager because the alcohol, the ABV is at like 4.7, so certainly a refreshing drink to have, and it's light. So you don't want to have anything too heavy with it. If we get into the whole food pairing section here, light. So cheeses certainly go. Think light seafood, shrimp, that type of thing. Something spicy, like maybe like the Asian, could go with this as well. You'd offset some of that spice with it a little bit. But yeah, so it's brought to you by Jack's Abbey. The folks at Jack's Abbey, we're very happy to have a fun with them. They were very kind to us. If you ever get a chance, go by the beer hall. It's at 100 Clinton Street in Framingham, Mass. The picture there in the middle is our boy Nick, who came and helped us out at an event we did for ARIES Foundation. Was able to do some tastings and have some fun with the crowd. Gave them a little bit of insight and a little bit of info. So we had a lot of fun with that. Skål.
Skål.
Yes, very tasty. And as the official beer of the Boston Celtics, they need a win this evening. So that was the other reason for putting that on there. All right, so the agenda for this evening, right? Sell in May and go away. What the heck is that all about? The roller coaster that goes on, some of the things to watch and talk about, and just ideas here of what's going on and why maybe it won't work this year. Before we get into that, though, just know for everybody out there, if you've got questions, whether it's just on investing, whether it's on your portfolio, whether it's on looking at what you're doing, Craig, or what you're thinking about, just reach out to us. The link's there. You can see the QR code. If you're watching this on the YouTube channel, pause, right? Hit whatever you have to do to pause it. Quick, take the phone out, shoot the QR code. It'll open up our calendar, and you can just schedule a time with us. We're happy to have a conversation. There's no obligation. There's no cost for that. That's the reason it's what we do, right? That's the whole point of what we do, Craig.
That's right. You can have a meeting with the star of our shows.
All right, so sell in May and go away, and where does this all come from, right? So the whole idea is this actually goes way back, even before the US markets, right? This goes back into merry old England, right? This goes way back, and it had to do with when you were buying and importing stuff and when they would ship out and when they would come back, type of thing. And it sort of got taken over by the US markets. And there is some historical data behind this. And generally the idea is that when we do, what were those, we were talking about that earlier today with one of our presentations, the Monte Carlo simulations, right? When we do the iterations of market performance and look at different months and times and slices and history and year by year by year, what they found was the 6 most positive months of the year actually begin November and end in April.
Oh, wow.
The worst 6 performing months of the year are May through October. So the idea there is, and what's sort of held with that is that, you can just think of it, right? What goes on once we get out of October? What do we kick into in November and December?
Well, holiday season.
The holidays, spending. Generally, the market tends to be buoyed by that. You get into January, February, and there's all sorts of, hey, I'm doing stuff. Maybe it's tax things that are happening there in terms of that. So that by the time you get to tax time, that's when, it's like, okay, I'm done. And then everybody goes on holiday anyway from like June through September. So it all tends to go flat. And then come September, everybody comes back from holiday and freaks out because they haven't looked at anything for 2 months. So they start selling stuff. And then October, all the investment companies have their fiscal year ends. So they'll do a lot of selling to, tax harvesting and that type of thing. So it tends to tip the market there as well. So there is some reasoning behind this with it. So there is reality that does go. And yes, more often than not, if you, sort of try to follow the trend, it does work. why we don't think that's going to work now, and we'll get into this in a little bit, is because what happened last year and what went on last year. But before we do that, we do want to go through some of that stuff that's being tossed around, Greg, right? All of these wonderful terms and information and everything else.
Mm-hmm.
So look,
here,
we are mired in a slump.
Hmm.
We are mired in the investing world. It is called a tranche, TRANCHE.
Mm-hmm.
That basically goes like this. If you look at the S&P 500, it has bounced pretty much along 3,900 to 4,100 for a while now. Mm-hmm. And not, they call it movement, movement one way or the other, when a breakout session that you really haven't had. So, the high watermark for the S&P 500 was 4,700.
Right.
That was the beginning of 2022.
Mm-hmm.
That was a year and a half ago at this point. We've been mired in this for a while now. So we've been hanging out. We're not in bear market territory, but we've been, but like I said, bouncing right along the edges of it, skirting right along the edge. 3,800 on the S&P 500, 38 like 15 is the number that hits you at the bear market level.
Mm-hmm. So you're just saying that it's just holding the line at this point, waiting.
That's all we're doing. We're holding the basically waiting to see where the breakout's going to go and whether the breakout's going to go up or down. And we'll talk about that in a couple of slides about how that works for what's gone on in the past. Recession. We have done this over and over again. As far as we're concerned, we're in a recession. The Fed hasn't, rung the bell on that yet, but we're in everything sort of points to the only thing that the reason we're not is because of the job market. The job reports keep coming out positive. Everything else has been, a key indicator for recession.
Yeah, I think, right. I get this question a lot too. Are we in a recession? Are things, going that way? I think the issue is the last few years have been obviously out of normal, right? For lots of different reasons.
Right.
Like you said, we've been kind of floating around with the S&P since the beginning of 2022, yet inflation is up. So you would think that stock would fall, but it hasn't. You would say, well, geez, we're in a recession and people are worried about spending money. Yeah, if you go out, the restaurants are full, the stores are full, people are traveling.
Right.
So they're still spending money.
It's still moving along, and that's what's the head scratcher and the hey, what the heck is this about? And the inflation's the last one on there. Mm-hmm. And inflation, like you said, inflation has started to come down.
Yep.
But it's still in the high fives, basically, from where we were before, and well above the marker where the Fed wants us to be.
Right.
So
the question you're looking for isn't happening. Or hasn't happened.
Right. And so where does it go from here is ultimately the question is, does, anything that ticks this thing up, the Fed's going to raise rates again.
Well, a quarter of a percent, I hear, right?
Well, they just did. They just did that,
mm-hmm.
But they'll, if inflation pokes up, they'll do it again in June. Mm-hmm. Don't put it past them. They'll just keep bludgeoning away as long as they don't care at this point. We've come this far, it's just like, I'm not going to stop swinging a hammer now.
Right. But we were doing this 2 years ago and we were talking about how, the stock market keeps rising up, even though we've got a zero Fed rate for so long. Right. So our complaint then was bond market was upside down and fixed instruments sucked. Well, this raise in inflation is actually kind of bringing us back to some equilibrium where you're seeing now fixed rates are getting better.
Well, right. But we'll talk about that in a little bit, because that's what's the flip side of why sell in May and go away may not work this year. And so we'll talk about that as where that's coming. Right.
And so get ahead of your slides.
Yeah, no, that's okay. I mean, in terms of this, because we are sort of bouncing around with all over this, but some of this, we talk about how the roller coaster of emotion that happens with the markets, right? And so, inevitably everybody buys in at euphoria, like everybody like making money, like everybody, I got to get in, that whole FOMO thing, fear of missing out. I got to get in, and then inevitably what happens is we're holding out in desperation. Like you know what, I know it's got to come back. It's got to come back. And then eventually we sell out in panic. And then it starts all over again. And this is what happens with us when we cycle. And a lot of times this is because we're chasing returns and we're not like setting goals and having a set, you know, this is what I'm trying to achieve, that all of a sudden, if I'm trying to get more return than I necessarily want to take the risk for, I wind up in this cycle. I sell out when I shouldn't. I buy in when I shouldn't. I do things that inevitably cause me to harm with my money and my finances. And then ultimately all that's left is drinking.
Well, it's lack of a plan, and it's also being outside of what we call your risk tolerance.
Well, and outside your comfort zone, right? It may not be something you want to deal with or talk about or actually have ever looked at. And that's why you need somebody, a sounding board to talk to.
Absolutely. Yep.
So we were talking about that whole thing with the tranches, right? And going through this. And so this is just a quick snapshot, just not to bore you with going back to the Great Depression and all the other crap, right? But so
depressing.
If you start with the Great Depression and go all the way through to the housing bubble in 2009, right? There's been 20 times that the global markets have crashed, basically just collapsed, right? And this is what they look like. If you basically averaged them all together, Greg, and laid them out on a board, this is what the average would look like. That they went from about a 50+% decline from the top to the bottom.
Yeah.
They came back about, almost, it was 3/4 of the way or so to there in a period of about a year and a half to 2 years.
Yeah, that's huge. Right.
Then you had like what we call the aftershock, right? Where the market it drops again. And the aftershock occurs somewhere in that, 24 to 36 month range. And then we eventually will come back up slightly from there. As you see, we're still down from the top. And then guess what we do from there? We tranche for a while. And then once that happens, on average, it's about 3 years of this tranche that occurs, right? We go sideways, and then the bull market runs. And here's where the optimism for everybody should be, is that if you sort of try to squish the pandemic into this model here, we're running somewhere in that, we're running sideways right now. We had the decline. We shot back so quickly. It might have been a rubber band how quickly we jumped back, because we were back within 6 months. The aftershock was in 2022. That was last year. That was the aftershock that occurred. We've bounced back a little bit from it, right? Maybe, just getting our head up. But like I said, we've been running sideways in this tranche for a bit now, where, this whole thing of coming out of the recession, coming out of the bottom, does it now say, all right, but once we do, and once that happens, like the market then moves, right? The bull run occurs, and a bull run generally lasts for about 5 to 7 years.
So it's probably about time to start getting your horses loaded in the gate here.
Well, there's the whole thing of why you maybe don't want to be selling in May. This is the first part, because we don't know when this is going to take off. And if you're going to wait 6 months for it, maybe you miss the uptick. I'm not telling you it's going to happen this year, but this is the conversation of why holding may be a better scenario than selling in May.
Well, typically on average, how long does the market do the crab walk?
The crab walk can go anywhere from like 2 to 4 or 5 years.
Really?
Oh yeah.
And we've been there about a year now.
Right, a little bit about a year.
Wow. Okay.
Exactly. So you probably will crab walk for another year.
Okay.
But that's what I'm saying is, when it takes off and runs, especially if we're coming out of that R word, the recession, the return after a recession is in the 20s. It's a Kickstarter, right? Boom, and then we're off to the races. And generally, the bull run doesn't go straight up. We do have little zigs and zags that occur in terms of it, but until we drop back into a bear market, that it'll continue to run.
Well, the bit more important piece is everybody's expecting this aftershock again, another aftershock, or even worse, initials.
Yeah, and again, who knows? You can't predict it, but there's nothing from the history that says that's going to happen. So that was just
At the end of the conversation, aftershock came in.
yeah,
It was like an aftershock.
It's an aftershock. All right, so here's the other reason that we shouldn't be dealing with sell in May for 2023, because when we look at 2022 and being as blunt as we can here, we have beers in hand, so we can do that. 2022 sucked, right? There's just no way to just paint that or say it any other way. Look, this was the 7th worst equity market on record. 7th worst. This is the top 10 you don't want to be in, right?
Okay.
The 7th worst ever. So that's painful. So equities were like, okay, I can't. I'm getting everybody, no matter who you talk to. They're like, oh, it went down. Like everything went down. Like, yeah, everything went down. But then, like you mentioned, Craig, the bond market, right? Where the bond market had been standing on its head and been twirling around and going crazy for 5-6 years. This was the worst US bond market ever since they started tracking the US bond market back in the 70s. This was the worst bond market ever, right? I want to say it was down 13% in 2022 overall. So if you think of that, like what you said, like, well, hey, but see, last year, all those interest rates just beat the crap out of it. All those interest rate rising, all the constant swinging of 75-point hammers killed the bond market after it had been beaten up badly for 5-6 years anyway. This, so the other reason for not selling now is like the only way 2023 could be worse than 2022 is the Great Depression. I mean, that's literally the category that you're in here in terms of moving the scale, like the marker to get worse. So it's almost like it can't be worse than last year. I mean, yes, we could be down, but compared to last year, it's going to feel like a win,
Right. Yeah. So if you got through last year, you should be feeling pretty good right now, even if you're not happy with your numbers.
Right. And like you said, where some of those allocations and some of those strategies in fixed income now are starting to look a little bit like, wait a minute, I'm getting return here on something, but suddenly, because now all of those hammer, just the swinging away by the Fed to raise interest rates have suddenly made some of those things much more attractive.
Yeah, and I think you also got to fight the urge to push everything into those attractive bond markets too, because then you also lose on the upswing when the market comes back. So
yes, see, there's the whole point. Yeah, you don't want to be doing that.
Yeah, I mean, it's nice as a security blanket to give yourself a little bit of a cushion, but you just want to look at your overall portfolio before you go pushing everything in one direction.
Correct. And just to go back to the adage, if you did that, you're probably selling equities and moving into bonds, which means you're selling in May and moving, right. Which is what you don't want to be doing.
Right.
Waiting to see what happens here, see how this all shakes out, I think makes sense for everything. Because like you said, it'll give the bond market a chance to settle here, see where things sort of level, what happens with everything that's going on in terms of all of that occurring.
Yeah, I mean, it's probably a better time now to actually start looking at your portfolio and seeing if it's in balance.
Yes, yeah, right. And we'll talk about that in terms of going through it. So, we beat up inflation and recession, over and over and over again, and pretty much all of our shows here. But, it's important to understand the idea of trying to get this into control, what the Fed is trying to do with this. I mean, they really have, one tool, and that's raising interest rates. There's really not much else they can do, right? So they're going to keep swinging away if they feel that inflation is getting out of control again. They will go. They'll keep raising interest rates.
Yeah, I mean, and I think it kind of sucks because a lot of this inflation will happen within 15 months. But
Yeah.
But you got to look at the fact we haven't had any inflation for almost 8 years.
Right.
So you're getting this adjustment that's coming all in one big swoop, and that's why it's so painful.
Exactly. And some of those pain points are similar to what's happened in the past. That's why you've got, some of this conversation occurring because there, I don't, God bless, I'm old, but I don't remember it, with the early 1980s when was the last time this happened.
Mhm.
And the Fed just, raised the overnight lending rate into double digits.
Yeah, and it really put a hurt on the real estate market back then.
It put her and everything.
Yeah.
It clamped down. It took them 4 years to get out of it.
Mm-hmm.
But they, that was the whole reckoning at that time was this is what we got to do. We got to get inflation under control.
Mm-hmm.
Recession, on the other hand, right? We went through this, so I'm not going to go too deep into recession, but just know these are the things that are going to keep theming around over the next couple of months between inflation and recession. Where are we? What's going on? Is the Fed finally going to ring the bell on recession, or just, let us wallow away here and understand that? Though I did see that the price of eggs was coming down, so that was a good thing to hear, or just to read that was happening.
Yeah, I mean, you also got to be careful too, because you're a year and a half away from elections, and you're going to be people trying to get you all riled up. This is bad. This is bad. This is bad. So just beware of doom and gloom in the marketplace.
Yes, yeah, that's a good point, because that'll come next year, right? That'll be, as we get to I was gonna say the end of this year, really, you're right, is about when that will happen. So, where do we go from here? At this point, I think, at least from my side, Craig, I'm more on the bull side of the table than the bear. And a bull, just so you know, is growth. That means the markets are going to take off. A bear is hibernating. That means the markets are going to go down.
Mm-hmm.
Not that we're going to run today, not that we're going to possibly even run this year, but I really believe by sometime next year, we will be positioned to take off. And again, by that, I mean the bull run will happen, and after the last one, which was the longest bull run on record, that went, over 7 years. And the only thing that caused it to stop was a global pandemic. And even at that, it dropped for 6 months. And we still haven't stopped spending, like you said.
Well, I think a couple of things start. One, the Fed had interest rates at zero forever, so money was free. Why not borrow it? Right.
Yes, a lot of free money.
So that keeps things moving along pretty well. I think the other thing going on here is, I just had it in my head, now I lost it.
Okay.
Is that, well, I'm sorry, the bond market sucked. So there were no fixed instruments to actually move into.
Right. You couldn't get yourself out of the market. You had to stay invested. You had to keep plowing money in. Yeah, absolutely.
Yeah, so the run had to keep happening.
So this year has to be better, right?
It will be.
It will be. It just, we may only be the fourth worst, the 10th worst equity market on record instead of the 7th. But no. I mean, the whole idea here is we're better positioned. Like Craig said, there's better stuff happening in the fixed side of the world. The market is certainly prepared after all the headache of last year of all the interest rates, and for the most part have pretty much, we've through it. And really believe we're through it, unless something weird happens with inflation numbers to drive the spike again. Then more than likely the Fed will say we're pausing, we're stopping, we're not going to do this, and we'll revisit. And I think that'll spark things a little bit too going forward from there. The adage during the pandemic was wash your hands, don't touch your portfolios. The adage now, and last year we were telling you to touch your portfolios because we wanted you to be aware of what was going on and to know that all of this craziness was happening. We're back to the don't touch your portfolios. Right? Or at least, as Craig said, look at the allocation strategy, look at your risk look at your time horizon, formulate a plan off it, that maybe then towards the end of the year, beginning of next year, then we can have the conversation about reallocation strategies for your portfolio.
Yeah, the big thing here is to try to get off the emotional roller coaster when it comes to
Yes.
investing, right? Because
Absolutely.
what people do is market goes down, they start selling. Well,
Right.
that's just the opposite of what you do if something's on sale, right? Usually when you start buying. So
Yeah.
if you're down, this isn't the time to like pull more money out. It's the time to put more money in because you're dollar cost averaging.
Absolutely. And that's what can you do, right? Right. So you can review your strategy. You know, what's your allocation mix? And again, we're not saying pull the ripcord. We're not saying do it, but just look at it. Know what your mix is. Know what your tolerance is. Crash test your portfolio. Crash testing your portfolio takes the idea of, all right, gold drops, interest rates continue to rise, oil drops, oil rises, the treasury rises, whatever. All of these things affect how your portfolio is going to manage going forward. That's crash testing. It's sort of like the dummies, right? When the dummies run into the wall with the cars, right? Crash testing. The idea is you're crash testing your portfolio. Just what happens, worst case scenario. The one thing we don't have the ability to do yet is crash test for a pandemic. It's still not available, but they're building the models to say what happens if another pandemic hits.
Well, hopefully it won't be another 100 years till that happens. So
again, losses are only on paper. They only exist until you sell. So the minute you sell in May, you lock in if your portfolio is down, and more than likely, based on the conversation, your portfolio is down still. And reassess your appetite for risk, right? Because Craig, risk is about everything. Return is great, but everything should be built off of risk. Once you've assessed,
and your risk tolerance changes based on your life situation. Are you older now? Do
you got stuff, you got other things, you got people you're worried about, all those things.
Right. Mm-hmm.
Absolutely. So again, we're here to have those conversations with you. We're here to talk to you. We actually can do a crash test with you. We can help you walk through the idea of crash testing your portfolio to say, hey, what would that look like if X happened or Y happened? What would your portfolio do, or what would happen to it in that scenario, so that you can be prepared for the next time we go off the cliff, which, in today's world seems to be happening more frequently than we'd want it to.
It's terrible. If I knew you were going to do that, I would have worn my helmet.
There you go. See, or we could put
my helmet.
We'll have to get those things. We'll have to get those.
Close by, but it's not. I can't reach it. So
that's okay. You are live.
When we do the crash test, I'll wear it.
Yes. All right. So we keep the think with a drink theme going. What's on tap? So next week, it's Disability Insurance Awareness Month. I didn't have the insurance part in there, but it's on 5/18. It's Disability Insurance Awareness Month in the month of May. And we're just trying to make everybody understand what disability coverage is all about, how it works, what it means. Sometimes we get it from our employer. Sometimes it's offered to us. Sometimes we have it and we don't know it. And so what are the ins and outs of that? And then on the 25th, it's take the stress out of your summer vacation, because everybody wants to get away in some way, shape, or form. And we want to do it in a relaxing and stress-free manner. So if you ever have any questions, you can reach out to us. You can go to the website. Again, it's ariesfoundation.org. We got an email. You can shoot us that, info@ariesfoundation.org. But the easiest thing is, again, if you're watching this on the YouTube channel, just pause it, shoot that QR code. It'll open up our calendar, and we're happy to have a conversation with you. Craig, anything you want to add to that?
No, just like I said, we're here to help. So take advantage of that fact.
Absolutely. On that note, we're going to say thanks and have a great evening.